fundsupermart.com.
Hi Garth. There are more balanced funds that invest specifically within Asia in the recent years. Can you share how the Schroder Asian Income stands out against its peers within this space?
Certainly. The fund is designed to meet a specific investor need, and that is for income. I think with government bond yields being at historic lows and interest rates unlikely to rise for at least the next year, investors are looking for other sources of income. And so we designed the Asian Income Fund to deliver them that yield. However, a lot of investors think that there's a choice, income or growth. But what we're trying to do in Asian Income Fund is give income and growth. And if you look at the performance of the fund since we launched back in 2011, the annual return has been around 11%. Now we've currently got a payout on the fund of 5.5%. So we're able to give people a nice payout, but we're able to give them growth as well.
Investing in Asian equities and fixed income exposes the fund to a wide range of currencies. How is the fund's currency strategy being managed?
Well, when it comes to currencies, you're right. There is a lot of non-base currency exposure. And the way we think about currency exposure is, firstly, we manage it actively. So we're very active in how we manage currencies. Now, what makes us decide whether or not to hedge a currency exposure? It's really two things. The first is, what's our view on that currency? So at the beginning of last year, the beginning of 2013, we allocated to Japanese REITs, Japanese property companies. That gave us some yen exposure. We had a very negative view on the Japanese yen. Like the companies, didn't like the currency. So there we hedged back the currency to base currencies. We hedged out the yen exposure, and we maintained that position. In other cases, maybe we don't have a specific view, but a currency is very volatile. And a good example of that would be something like the Australian dollar, which has been quite up and down. It's got quite expensive, it's got quite cheap, it's been quite volatile. And there, particularly if it's trading towards the top of its trading range, we would tend to hedge out the currency because we don't like that extra volatility. And that often helps when you have a market correction. Having hedged out those higher risk currencies helps stabilize the fund's performance.
What are some of the drivers of yield for your portfolio?
It's interesting. A lot of investors rely on fixed income for their yield. But actually, in Schroder Asian Income, more than 50% of their yield comes from the equities. Now that's interesting because we can find a lot of companies that are paying very nice dividend yields. For example, in the telecom sector, in the property sector, and in the banking sector. So there we often find companies which pay 7 to 8% dividend yield, very healthy, comparable actually to bonds. But you avoid two things. Firstly, you avoid interest rate risk, so the interest rate risk is less. And secondly, you avoid the probability of default. So for example, if I look at the type of companies we have in the portfolio, they're paying a nice healthy dividend, strong balance sheets, and even if there's an economic slowdown, we think that their dividends are likely to be sustained. Now, we do also have some high-yield bonds in the portfolio. So at the moment, we've got about a third of the portfolio in higher-yielding bonds. There, we need to be quite careful. It's very tempting to go and buy, let's say, Chinese property developers with 12, 14% yields. I mean, that would be very easy. But obviously, you get that return, but you take on a lot of risk. And we're actually turning a bit more cautious on that sector. So we tend to actually buy the higher quality names, slightly lower yields, maybe between 6, 7%, but we think less likely to be impacted by a slowdown.
It was mentioned that the fund had to stop new subscriptions in early 2013 to allow the fund manager to manage the fund efficiently. Were there any introduction of measures to help cope with the fund's future burgeoning capacity if that were to happen?
Yes. First, let me say that we're very disciplined about managing capacity. We think it's more important to protect existing investors than let the fund get too big and try and be greedy and take on too many new investors. So if we're not comfortable with capacity, we will close funds, and Schroders has a track record of having done that. In the case of Schroder Asian Income, one of the big drivers of capacity is in the fixed income space. Can we buy the bonds that we need? And there, it's been very good to see that the issuance in the fixed income space has been growing. So as the bond market in Asia continues to grow, investors get more comfortable with it. We're seeing much more issuance, particularly on the industrial type companies are issuing new bonds. And so that means we're confident that capacity won't be an issue for a while to come.
Thank you.
You're welcome.